My name is John O'Donnell. I think what everybody wants to know is what's 2010, what's 2011 going to bring us. I would encourage you to write down my email address. At the end of this seminar, I'm going to make some kind of an offer, and you need, it's a free offer. You need to email me to get it. My email address is John, John, @tradingacademy.com. I'm John O'Donnell. I'm the Chief Knowledge Officer at Online Trading Academy. And the title of my presentation today is 2010-2011 Market Forecasts. I should have subtitled my talk, Perception versus Reality, for what I call the new normal economic era, in what I call the Globalization 3.0 credit bubble deleveraging purge cycle. And that's exactly what we're going through, and it's global in perspective. There's been a lot of information published about it. There's a lot of misinformation, and I'm going to try to bring some clarity to the subject, at least from the Online Trading Academy perspective, because I think it's going to impact the valuation of all currencies. I think it's going to impact the valuation of all asset classes, regardless of what currency they're denominated in, going forward. And we built the largest trading floor in California. Matter of fact, it was the largest day trading floor for equities, and we would execute about $500 million a day of trades on that floor. And we modeled into what we've become today, and we now have 33 offices across the world, including offices in Singapore, Great Britain, Dubai, and I'm pleased to announce we're going to be opening in Mumbai, India, in first quarter this year. So, and we are growing very, very rapidly. And we encourage all of you to become a member of Online Trading Academy. Membership is free. You can go to our website, tradingacademy.com, if you'd like more information on that. We host classes on options trading, foreign currency trading, futures trading. We have a day trader class we call the Equities Pro Trader class, and we have another experience known as Proactive Investor. And then when somebody finishes our learning events in one of our learning labs, 33 learning labs across the world, which are computerized learning labs, we have a continuing education forum we host on a platform similar to WebEx, where we do virtual coaching and teaching. Now, this is my friend CP. That really stands for Capitalistic Pig. And CP is my buddy. He goes with me on my speaking, writing, and publishing and tours across the world. And CP tells us that what we need to focus on in this era of the transition to the new normal, and we'll talk about that in just a moment, that capital preservation needs to be first and foremost in our minds. I know why most people are attracted to this industry, because they want to make money, but at the end of the day, the most important thing we really need to focus on is capital preservation first. Now, there's a raging debate happening in the world today, and it's a debate worthy of having, and both sides bring to the conversation of inflation versus deflation debate. And there's one camp that believes in inflation, that the coordinated effort by central banks across the world are going to reflate the system, and their evidence for that is the massive deficit spending programs that developed countries are doing. And then there's another school of thought. It's a quieter school, and probably with less participants in it, which is, no, the inflation program isn't going to work, and we're going to continue to have a serious bout of deflation. Now, I want you to vote on this. We've got about 70 members in this session today listening to this presentation live. And what I'd like you to do is vote. And I'd like you to just enter in the text chat right now. Which camp do you stand in? Are you an inflationist? Are you a deflationist? So if you would, please record your vote in chat right now. And I'd like everybody to vote. Just give me your opinion. Do you believe going forward we're going to have deflation, or do you believe we're going to have inflation? Let me know what your opinion is, because your opinion's important. Come on, put it in there. Everybody vote. Now, there are two sides to every argument. In this case, there's the insane side, and then there's the other insane side. So right now, it looks like we're kind of, it looks like the inflation camp seems to be leading. Well, by the time I finish this seminar, you'll understand what camp I'm in. But I do respect and appreciate everybody's opinion. As you can see, if we were to line everybody up, come on, we need all 70 of you to vote. Everybody's entitled to a vote, an opinion. Nobody's going to hold you accountable for it, so participate. Do you see inflation or deflation? Well, the inflation-deflation scenario is filled with insane theories, ludicrous claims, preposterous notions, and by the way, that's just the politics of it. I want to share something with you. Let's first of all define our terms. I'm surprised some of you didn't ask me to define my terms. Let's take a look at my definition for inflation, as defined by Webster's Dictionary, by the way, is it is an increase in the currency supply and credit relative to available goods. My definition, according to Webster's, for deflation is the obverse of the first, which is it's a contraction of the currency supply and credit relative to available goods. Now, what most people miss in the inflation-deflation debate is the and credit component. And here's my question to you. If you look at the global developed world today, Western Europe, North and South America, certain parts of East Asia, is credit contracting? Is the availability of credit shrinking? Is the existing in-place credit component expanding or contracting? Now, we've got two sectors we need to look at. One is the government sector, and let's call that the public sector, and the other is in the private sector. And in the private sector, which in America happens to be the American family and the American corporation, credit is shrinking at a much faster rate than we can print money through our central banking mechanism. And that's happening right now in most of the developed world, and that's the primary reason that prices for most goods and services are falling. Now, historically, my flight to safety play that the world historically has used are long-term treasury bonds. Central banks use U.S. dollar-denominated long-term treasury bonds as their proxy for the flight to safety trade. Now, we've seen a tremendous move in the bond market from July of 2002 right back here, and we just broke the trend last week. And I guess my question that we all have to ask ourselves, is the flight to safety trade over? Well, that debate also needs to take place. There's some other anecdotal evidence that we're starting to see and have seen since March 9th, a significant recovery in the equity market in the United States as measured by the S&P. This is a weekly chart of the S&P showing you the reverse head and shoulders that we had at the bottom in the 2002-2003 era being mimicked again right here in March of 2009. And this whole rally we've seen since then, if you put it in perspective of the big picture, is potentially telling us that we're starting a new secular bull market. And that debate needs to take place. Now, what technicians are using to forecast this return to a new secular bull market, meaning a bull market of long-term duration, is this area here where the 40-week simple moving average, this arrow, has crossed over the 80-week simple moving average right here in blue. The 40-week simple moving average is in purple. And we've seen it again right here, and we've seen it again right here, and we've seen it again last Friday right here. So let's keep an eye on this, and I would encourage you to put into your technical analysis study, if you want to follow how this trend develops, and I'll show you where I stand on this situation today. and that we are the end of the old normal and we're transitioning to the new normal. And major shifts in sentiment have long-term ramifications for virtually all asset classes: real estate, currencies, metals, and equities, and bond market. Now, this whole era that we're transitioning to today seems to be led by a trend toward frugal global demand destruction. In America, ladies and gentlemen, 70% of our GDP, we have the leading GDP in the world of about 14 trillion. 70% of our GDP is consumption. And the American consumer buys the finished goods that the world produces. Think about this for a moment. America, about 350 million strong in population, is about 5% of the world's population. But yet, through our high standard of living, we consume about 28% of what the world produces. And the world looks to us, the world producers and savers look to America to be the market, the final market for finished goods that the world produces. Now I want you to think about this for a moment. Where were you 20 years ago? What were you doing? Where did you live? What were your hopes, dreams, and aspirations 20 years ago? Think about where you were in December 1989. Think about where you were in your career. Think about what kind of home you lived in, what kind of income you had, what your goals and aspirations were for you and your family going forward. Now let's think about where General Motors was 20 years ago. Look where they are today. They've just gone through bankruptcy. They liquidated, through their credit purge cycle, $130 billion of debt. And they've had to transition and reinvent their new normal lifestyle. And the jury is still out whether a General Motors is going to be able to compete with the foreign automobile companies. But you and I have had to transition our life, haven't we, over the last 20 years? 20 years ago, I was an investment banker. Trust me, I became a principal in Online Trading Academy on about the founding of the company back in 1997, 1998 era. So I've been one of the builders of this business. And trust me, 20 years ago, I had no clue that the opportunity for me to sit in front of a webinar with FX Street and talk to people all over the world, that capability was even going to exist 20 years ago. So all of us have had to transition to our new normal. And ladies and gentlemen, let's talk about what created this credit purge environment. You see, we've had many periods of long, and the two that I want to look at today to bring your attention to was the credit purge of the 1930s right here in America. And what we're looking at is total debt as a percent of GDP. And we are now in the new normal credit purge era, and we'll talk about it in just a moment. We're in the very early stages of this credit purge environment. And you can see, ladies and gentlemen, that this chart measures, and this chart's a very important calculation. It's measuring how much debt does it take in a highly developed capitalistic economy like America to produce a dollar's worth of GDP. So no matter how big our economy gets, no matter how diversified the basket of products and services, we produce or consume, how much debt does it take to fulfill that economic model? And this is what it's looked like since 1870. Now, notice from 1870 through 1920, debt as a percent of GDP was about 150% of GDP, right along this line. There was a credit binge in the 1920s, which turned out to be unsustainable in 1929, and we experienced the credit purge environment of the 1930s. And as a percent of GDP, this is the high water mark for credit purge as a percent of GDP. It's the biggest the world has ever seen. Now, you cannot have a credit purge era without a credit binge era that set it up. Now, after the credit purge of the 1930s, we go right in here and look at this. From roughly 1940 through roughly 1980, another 40 years of time, we had debt as a percent of GDP in America, and we had some remarkable growing economies during this period of time, but debt as a percent of GDP was only about 150% of GDP. And who was elected right here? 1982, Ronald Reagan. And we have another credit binge environment, and we've had a 20-plus year credit binge environment. And now, ladies and gentlemen, we're going through the credit purge of that side of the equation. Now, what has been the primary driver of debt as a percent of GDP? Well, if you take a look at this chart in blue, we've seen total debt as a percent of GDP go from roughly that 150% of GDP era all the way up today to over 360% of GDP and growing. On the other hand, we've seen the personal savings rate of the average American fall. Here in Jimmy Carter's era, our personal savings rate was up here at about 12%. In Reagan's era, start of his term, it was around 12%. And this has been the trend in savings in America by the average American family, going to a negative number, and today it's back up to about 3.5%. We borrow, ladies and gentlemen, over $2.5 billion, and some say we're now borrowing in years going forward $3 billion per day from the world savers. So we need the world savers. We need the world savers to recycle their savings to America. That's very, very important. Now, what's interesting is that we've seen in history these boom-bust cycles and credit purge environments before. This is several economic mood shifts going back 300 years, all the way back to where we were using the pricing on UK equities. But these credit purge environments, as you can see, are quite infrequent. My study of these cycles is you're only going to see one of these probably once in your adult life. And if your life expectancy, as measured by existing insurance mortality tables, is about 76 years, once in your adult life, which is about half your life cycle, you're going to see a credit purge environment like this come along, which is going to have huge impacts. And what happens during the credit purge environment is all the infrastructure that we finance, too many malls, too many cafes, too many burger joints, too many coffee shops, too many office buildings that were financed with too much debt, well, all that debt is going to get purged out of the system, or the weak holders are going to give up the debt, and the property, much of it, is going to return to the original mortgage holders. And we've just seen this take place. Best example of this is General Motors and some in our banking system. Now, what I find interesting as I look at longer-term cycles and economic ebb and flow is that this is an index you probably haven't seen before. This is not the S&P 500 index. This is the S&P Composite Index of U.S. equities from 1871 through 2010. And I want you to note something. At Online Trading Academy, we are advocates that you use an inflation-adjusted pricing or valuation mechanism. We are advocates that you must have a constant benchmark of measurement. You know, what would the world be like if 60 minutes were not an hour everywhere in the world? What if an hour was measured as 48 minutes in Europe, 60 minutes in America, and 32 minutes in Asia? Think about it. There'd be chaos. What if a BTU of energy wasn't defined? What if a meter wasn't defined? We must have constant metrics of measurement. Well, if you're always using nominal pricing in a non-inflation adjusted purchasing power parity to a specific currency, you're always going to have a distorted view of the valuation or the purchasing power parity of that asset class relative to its peers. Now let's take a look at something. This is the inflation-adjusted valuation on the S&P Composite Index going back to 1870. And note something which is remarkably important that the buy and hold investor-biased community across the world seem to want to not recognize. We've had several unsustainable rallies of valuation in real terms, and every single one of them, as measured since 1870, have turned out to be unsustainable. Each and every one of these were followed by a period of not only going from irrational exuberance to a state of irrational fear in an oversold condition, as measured in 1877, 1921, 1932, 1949, 1982, and 2009. And none of the oversold conditions have been sustainable without exception. So you and I need to think and act and deploy our capital from a capital preservationist point of view, and recognize that this is the trend. And it's an extremely well-established trend that valuation extremes of overbought and oversold have never been sustainable. Now, why do we think it's different this time? I don't know why we think it's going to be different this time, but those are very dangerous words. Now, another way that I can measure valuation is a metric that we use at Online Trading Academy known as the PE10 ratio. The PE10 ratio is using, again, the same S&P Composite Index from 1870 through 2009, and I'm an inflation adjusting price of this index to the price to earnings 10-year moving average. In other words, the PE10 ratio is based on the real monthly average of daily closes divided by the 10-year average of real earnings. Real earnings meaning earnings per share adjusted for inflation. Now let's take a look at this. Isn't it incredible? Can somebody tell me why in the world there are some economic periods of time where corporations are valued at 32.5 times earnings, and in a short reasonable period of time, that same group of companies is valued at only 5.6 times earnings? In other words, look at these price extremes which led to these valuations also of overbought and oversold. And again, this is further confirmation. Where are we on the pendulum today? Well, what drives demand? What drives this supply and demand equation, which drive these market valuations to unsustainable premiums of overbought and unsustainable discounts of oversold? Now, you and I need to get on top of this, and I think you need some coaching and some help, and of course that's what we're in the business to do. And it isn't just war times. These things happen in all economic conditions. Forget war for a moment. Wars are quite rare. You know, it happens in all economic conditions, with or without war. And most of it's driven by earnings expectation or the stability of earnings. Because at the end of the day, what's an equity worth? It's worth a multiple of cash flow. You know, what's a bond worth? What's a credit instrument worth? Well, it's based on the perception, is the borrower going to be able to repay the loan? Well, what's that going to be driven by? Cash flow. No sufficient cash flow, you're going to have bonds, bids slowly disappear or radically disappear in the case of the subprime mortgage crisis. And we'll talk about it in a moment. This credit purge environment has been with us, and I want to compare two senior credit purge environments. One was the Dow crash of 1929, and here again we're looking at long-term charts through the credit purge environment of three major credit purge environments. One, the one that we're in today, measured in blue, is measured by the S&P, and this is current, the last Friday's close. Two, the Nikkei credit purge that started in 1989, that's in red, it's already run for 20 years, and they're still in it. And of course, the Dow crash of 1929, which is in gray in the background. Now, when you adjust all of the prices of these equity indexes, which are the symptoms of the credit purge experience, because it was the credit purge experience that ultimately drove the pricing mechanism to price these three bear markets accordingly, you see a remarkable correlation of incidence. I think it's absolutely remarkable how highly correlated this expression of fear is, given the three remarkably dissimilar economic cycles that these three charts represent, and the remarkable dissimilarity between the culture of Japan and America. But at the end of the day, this is what they all look like. Now here's a chart you haven't seen very frequently, and a few people are talking about it, but you'll never see it on CNBC or Bloomberg. You know, I've been part of CNBC and Bloomberg. I've been on there many, many times as guests. You can see those postings at our website if you'd like to review some of my radio and television appearances on those two channels. But at the end of the day, ladies and gentlemen, I've never seen this chart on either Bloomberg or CNBC. And I think it's a very, very important. And as a currency trader, I think you need to be focused on this. I have been an advocate for 30 years. I used to own a gold and silver precious metals reclamation business in the back of the 1970s. My first exposure to gold was when Nixon closed the gold window back August 15, 1971. I'll never forget it. What I do every Friday, and what I recommend you do every Friday, if you want to keep your finger on the pulse of the equity market, whether in the UK or whether you're in America or whether you're somewhere else in the world, is ask yourself a very simple question. What is the nominal price of that equities index today, and how many ounces of gold does it take to buy that index today? So first of all, measure it in the fiat currency. If I'm in Great Britain, I'm going to maybe take a look at the FTSE, and I'm going to figure out how many pounds sterling, units of pounds sterling, does it take to buy the FTSE. But then I'm also going to figure out how many units of gold does it take to buy 1 unit of the FTSE index. Think about it. You know, if I live in France, or if I live in Spain, I'm going to look at their indexes, and I'm going to say how many euros does it take me today to buy 1 unit of that index, and how many ounces of gold does it take me today to buy 1 unit of the index? Well, let's take a look at America. The largest, deepest capital market in the world. This is what we call the Dow-Gold ratio, and I've been using this for 30 years. And I don't know if you're using it. It's a very simple ratio to follow. You can acquire it at investmenttools.com. Make sure you spell it right. It's got 2 T's. And this goes all the way back to 1978 in its expression. And what we're doing here in this chart is every Friday, we're taking the nominal price of the Dow, or a given major equity index, and you can do it with your country. We're dividing it by the price of gold. Now, I want you to note right here in 1979, we're pushing, that Dow Gold Index got all the way down to 1.2 to 1. That is, it took 1.2 units of gold to buy 1 unit of the Dow. This was the real secular bull market coming out of the election of Ronald Reagan. The secular bull market in our examination ended in January of 2000 at a 44 to 1 ratio. If you want to know the numbers, the Dow closed in that era at 11,700 on the Dow, divided by 250 gold. This has been the status since then. Where are we today? Well, today we're at about 10,600 on the Dow, and we're at about 1,100, and last quote I saw, about $30 on gold. So I would take 10,600 divided by 1130, and we've got the Dow Gold ratio today right here, about 9 to 1. In other words, ladies and gentlemen, we've had an 80% decline in the real purchasing power parity of the Dow, regardless of all these recoveries we saw in 2007 and this year from those strong sell-offs in October of 2002 and the strong sell-off of March of 2009. They are hardly even a ripple in this ratio. Now, why am I using gold? First of all, I look at gold as the ultimate currency. I don't look at gold as a precious metal. I treat gold as a currency. And it is a currency that has a 3,000-year track record of being both a medium of exchange and a store of value. And the beauty and genius of gold to play this role is that it's a currency that no central bank can print. And I find that absolutely compelling. And that's why I use it. Now, I could use any other commodity or index to create a ratio. Another way to do this that I have found remarkably similar in pattern and how it looks is the CRB index. Take the Dow and divide it by, every Friday, the CRB index, the Commodity Research Bureau index. I can also ask a simple question. How many barrels of oil does it take to buy 1 unit of the Dow? But I think if you'll start doing this evaluation, it only takes a very short period of time to do the calculation, put it on a chart, you will see, ladies and gentlemen, that we are in a secular bear market. And we have been in a secular bear market since early first quarter 2000. Well, let's talk about the credit purge of the Japanese market. All right? I want to make a comparison to the two. I want to look at the credit purge environment that we're in today. We've already looked at the credit purge environment of the 1930s. We know what that transpired. We know how long it ran. But now I want to take a look at the credit purge environment of the Japanese market. The Japanese credit purge environment started right here in December of 1989 at 38,900 on the Nikkei. I could also ask myself a very important question. How many ounces of gold did it take to buy the Nikkei index back in December of 1989? And you can go do the math on that one yourself. This is the transpiration of the secular bear market in the Japanese Nikkei index. And again, my evidence that they've been in a 20-year credit purge environment, I'll show you in just a moment. You see, my definition of a secular bear market is very well displayed here. It is a long-term secular bear market with a series of counter-trend rallies that have a high probability of failure. And that's exactly what we're seeing in this chart. A 20-year secular bear market with a series of cyclical rallies, and each and every rally that we're looking at here, without exception, has failed for 20 years. I would call that a trend. Now, what drove this? And what did the Japanese government do to try to bail it out? Well, let me show you what they did. Let's go back to our principle of debt as a percent of GDP. This chart is showing you from 1964 through 2009 total government and private debt as a percent of GDP for the Japanese culture. Take a look at this. Government debt, what do governments do? Well, most governments are led by Keynesian economic work. At Online Trading Academy, we are not Keynesians. We are followers of the Austrian School of Economics, and we create our courseware, our classes, and many of our trading decisions around the principle of Austrian economics, which is remarkably dissimilar from the Keynesian School of Economics. Now, unfortunately, almost all of the developed economies of the world follow Keynesian economic principles. And that's one of the reasons we're having this big challenge from my point of view. But let's take a look at what the Keynesian-educated Japanese government did. They tried to stimulate the economy and get it out of its funk by massive fiat currency printing and deficit spending. Government debt, Japanese government debt as a percent of GDP in 1989 goes from 52% of GDP, and today it's over 170% of GDP, well on its way to 200% of GDP, in my opinion. Now, did all that deficit spending work? Did it produce a sustained recovery for the Japanese economy? No. For 20 years, it has not worked. Well, what happened with the private sector of debt? Remember, the private component of debt is remarkably much larger than government debt as a percent of GDP. If you look at all the outstanding debt in Japan and America, in the private sector, in the family balance sheet and in the corporate balance sheet, it is a remarkably larger number than government debt as a percent of GDP. Now, what happened to private debt as a percent of GDP? Well, private debt in the private sector peaks at 273% of GDP and precipitously falls, look at this, to 113% of GDP. That's the equivalent of falling off the cliff. Now, what drove this? What drove the average Japanese corporation, what drove the average Japanese family to shrink or de-lever their balance sheet. See, there's two forms of deleveraging. There's voluntary deleveraging and involuntary deleveraging. Example of voluntary deleveraging is where you and I make the choice not to borrow money against our home and go out and buy a new car. We pare down. We become more frugal. We don't go to Starbucks 3 times a week, pay $3 for cafe lattes. We go once a week and we pay $1.50 for the Americano. We don't go on extravagant, expensive spending binges and living beyond our means. We get more frugal. We start saving money. Also, the Japanese demographics drove a lot of this because the Japanese culture demographic pool is older than our demographic pool. And the Japanese are not pro-immigration. So, ladies and gentlemen, what else did the Japanese government do to try to turn this around? Well, here's what they did. They propped up their zombie banks and corporations. They created a bunch of government jobs to fix the potholes and bridges. Did it work? Well, it didn't work at all. They didn't create any new jobs. You know, it's outrageous. Now, have you heard of this program attempting to be profiled in America? Everything I hear coming out of the current administration in Washington is to follow the Japanese model. Now, you tell me why that model of deficit spending, propping up the zombie corporations like AIG and Washington Mutual, and our banking industry, General Motors, is going to work. You tell me why that's going to work in America. Because, ladies and gentlemen, the other side of that equation is that the private sector is deleveraging. Debt is defaulting. Debt is being taken out of the system at a faster rate than our central banks can print money. And, ladies and gentlemen, that is deflation. That is, by definition, classic deflation. Now, what I find very interesting through this whole period of time is that this is the VIX index. There's a tremendous amount of complacency going on, and this kind of complacency, as measured by the VIX, is generally the sign of a topping market. This kind of anxiety, and I believe, ladies and gentlemen, that our rally is just about run out of steam. Now, here's my question, and I want you to vote here. Do you believe that the world economic uncertainty will continue in 2010? Well, this is a pretty smart audience. I think you're right. Unanimous choices are telling me that the world is in the midst. And I think you feel the same thing I feel. Maybe that's why you're learning how to trade cash and cash equivalent. And I think you've made a wonderful choice. The world is in the midst of the worst economic slump since the Great Depression. And ladies and gentlemen, let me tell you why we're not going to create a lot of new jobs. It's very simple why Japan did not create a lot of jobs, and they've been in an economic funk for 20 years. Now, I'm not saying we're going to be in an economic funk for 20 years, but we've been in a bear market since 2000. So our bear market is getting a bit long in the tooth. But let me show you why I don't believe we're going to create a lot of new jobs in 2010, probably into 2011. And that's because of the rising productivity, measured in blue, of output per hour of the American workforce. What is driving this rising productivity in an environment of less hours worked per week in gold? And what drives this big gap is how do you get more rising productivity in an environment where the average work week in America is 33 hours, but yet productivity is escalating at a rate we haven't seen since World War II? Ladies and gentlemen, you can answer it one way. In a recession, businesses let go and fire their most inefficient workers, and they keep their most productive, efficient workers. That's what universally capitalism has done since God invented recessions. Secondly, to template on top of that, we've seen a tremendous rise in productivity tools. The internet, email, just-in-time inventory systems, logistics. We've seen a fabulous rise in productivity tools. And the capitalistic system is going to continue to produce innovative productivity tools that will continue to raise economic output per worker. Ladies and gentlemen, what's going to happen in America? There aren't going to be a lot of jobs created because the average small businessman in America, which has historically been the engine for job creation, is going to run that work week back from 33 hours a week back up to 40 hours a week before they hire a bunch of new people. Because there's a huge burden on small business to hire new people, and they're going to continue to squeeze more productivity out of less people. At the end of the day, this will put this in perspective for you. Going back to 1965, the gray bars have been periods where we've had deep recessions in America, and this shows you how the work week has fluctuated, and you see startling declines in the work week per worker measured by each recession. And you can see where we are today, and you can see that it's remarkably more intense today than it has been in previous recessions. I'm a 60-year-old man. I remember this 1970 recession very, very well. This right in here, these two eras right in here is where I got my start in markets 40-plus years ago. This is where we're losing jobs, ladies and gentlemen. We're losing jobs. We've lost about 7 million jobs since 2007. So we can blame some of this on Bush. But believe it or not, of the 7 million jobs, 4.3 million jobs we lost were in 2009. So the majority of these jobs have been lost on the new administration's watch. Now, I don't think I'm ready to totally throw them under the bus because they inherited a lot of this mess, and it takes a long time to turn this economy around. But I believe we are still in recession. The U6 unemployment rate in America, which is that unemployment rate measured by the Department of Labor, with all the people who are underemployed, the people who are working part-time, that want to work full-time, the true unemployment rate in America today, and I think that's the most accurate rate we need to take a look at, is around 17.5%. So we have some real challenges in front of us, and I think you're going to see a continuation of the new normal economic era. It is truly a Darwinian purge. That is, it is survival of the fittest. And that's really what capitalism's about, isn't it? Now, in this period of time, there are going to be companies that prosper. There are going to be companies that Bank of America acquiring Merrill Lynch, Wachovia, Washington Mutual getting bought by J.P. Morgan, Lehman Brothers, Bear Stearns, those assets getting picked up by J.P. Morgan and Barclays Bank. I believe we're going to enter an era of huge consolidation. There are going to be many companies that are going to shed complete divisions. We recently saw Citibank shed off Smith Barney and amalgamate it into Morgan Stanley. You're going to see a lot of consolidation. The strong are going to get stronger. The weak are going to fall by the wayside. In America, we're going to continue to see banks. We're going to downsize banks. We're going to delever the balance sheets of banks. Some of it will be organic. Some of it will be voluntary. Some of it will be we're just going to see a bunch of banks go out of business and be consolidated in the hands of the stronger banks. Let me give you an example of what I mean by that. One of the graduates in our school out of our Washington, D.C. office heard one of my webinars, and he asked me on the webinar, he said, how many banks do you think are going to fail in 2010? I said I didn't know for sure because I didn't have access to the data, but my speculation was it'll be about the like amount that failed in 2009, and we lost 130 banks in America in 2009. Were taken out of business and amalgamated by the FDIC somewhere else. This guy calls me 2 days later, and I find out he's an employee for the FDIC, the Bank Regulatory Authority. He didn't tell me what department he works for, but he's become kind of my secret mole within the FDIC. And he said the data that they have access to looks like there's 550 banks in America on the watch list, the problem list, that are candidates for failure, and its conservative estimates is that 260 of those will fail in 2010. So, ladies and gentlemen, that's a bit of my update about the credit purge environment. No longer is the automobile industry my poster child for the credit purge environment, but my poster child now, believe it or not, is General Electric. Now, I know some of you, they got a real problem with GE credit. They've got about $550 billion of debt on their balance sheet. They've got about 10% of that in net tangible equity. Excuse me, they're levered. They've got about they're levered 50 to 1. And I think they got some serious challenges with some of their accounting. And I think you're going to see the market conditions force GE Credit to be upstairs. I need a computer with internet access. Okay. So at the end of the day, ladies and gentlemen, that's where we are. Look, I've got to go to another meeting. I've enjoyed being with you today. My name is John O'Donnell. My email address I'll leave here on the screen for a moment for you. I encourage you to email me. FX Street is going to record this, but if you email me, john@tradingacademy.com, I'm in our Irvine, California office. Visit our website. You'll see a lot of free information there. There's more of my webinars there. But if you want to email me, I'll be happy to give you some other research that I'm ready to publish in webinar form, free of charge. You'll see a whole bunch of free information on our website. I encourage you to go visit it. Tell your friends about Online Trading Academy. You know, our goal is to help all your trades be green. God bless you all. Good luck.